Welcome to the Deep Dive, where we cut through the noise, distill complex information, and bring you the concentrated insights you need to stay well informed.
That's the goal.
Today, we're plunging into the dynamic, pretty high-stakes world of market analysis. We're offering you a shortcut to understanding an expert-driven approach to spotting opportunities and, navigating that constant flood of information.
And our source material for this deep dive is, well, it's a real treasure for anyone looking to refine their trading strategies. We've meticulously reviewed key excerpts from The New Age of Technical Analysis, published back in 2022 by Brandon Rosewag, also known as Brandon Trades Online.
Okay.
Brandon's journey is actually quite interesting. It began in 2017, really driven by this desire to escape a career path that, simply didn't ignite his passion.
I think a lot of people can relate to that.
Absolutely. And through just relentless study, countless hours in front of charts, learning from mentors, and frankly, the hard-won wisdom of trial and error, he transformed himself into a profitable trader. And now he's a respected educator, too.
Right.
So this deep dive is designed to really distill his new generation of technical analysis, drawing on his extensive work to show you how he approaches the markets. It's also worth noting he gives a lot of credit to giants in the field, like John Carter for insights on the TTM Squeeze and John Person for the Person's pivots. Both are pretty pivotal to his methodology.
Interesting. So our mission today is crystal clear then. Extract the most impactful nuggets of knowledge, those key insights from Rosewag's comprehensive work. We're going to unpack practical strategies, maybe some surprising facts that can help you become more well-informed about how to approach the markets, particularly in this fast-paced world of options trading.
Yeah, it moves fast.
Think of this as getting a comprehensive overview of a skilled trader's toolkit, without having to spend years in the crunches yourself. Now, as with any discussion around financial markets, it's crucial we acknowledge the author's disclaimer. This material is for general information and educational purposes only. It is not intended as legal, tax, accounting, or investment advice, and importantly, all investment strategies inherently involve the risk of loss. Our goal here is simply to convey the author's ideas and methodologies, not to endorse specific investment outcomes or give you financial recommendations. We're here to enlighten, not to advise.
Absolutely. Well said. And to truly get a handle on Brandon Rosewag's methodology, we really need to start with the foundational elements of options trading itself. Then we can layer on the various indicators and strategies he uses to build, a robust trading plan.
Okay. Sounds like a plan. Let's dive right in then, starting with that foundation. What exactly is options trading and why does it seem to captivate so many traders?
Well, at its core, options trading is basically making a bet with another market participant on the future price direction of an underlying asset, like a stock.
A bet. Okay.
Yeah, it's a fascinating dynamic where you're essentially predicting whether a stock will move up or down, but using a specific mechanism, a contract.
So if you're bullish, you think the stock's going up, you buy a call option.
Correct.
And if you're bearish, expecting a drop, you buy a put option.
Okay.
And when you actually enter that trade, you're making three key choices. Is that right?
Precisely. First, that directional choice, call or put, bullish or bearish. Second, you select a strike price, which is the predetermined price at which the underlying asset can be bought or sold if the option is exercised.
Okay.
And third, you set an expiration date, a specific date by which that option contract expires. It has a limited lifespan.
Got it.
And for this contract, you pay an upfront cost, which is called the premium. Now, the allure, the big draw, is the potential for unlimited reward, which, sounds incredibly enticing.
It does.
But, and this is the big but, it has to be tempered with a crucial warning. You can also quickly lose a lot of money. It's definitely a high-reward, high-risk game. It's made more complex because you need to be right not just about the direction, but also the timing.
Right, that added layer of timing. That's what makes options so different from just, say, buying shares of a stock.
Exactly.
It introduces this need for, incredible precision. And this is where the Greeks come in, I assume. These are essentially your options cheat sheet, helping you measure and manage that risk.
Exactly. Rosewag states flat out that the Greeks are one of the most crucial elements for options traders. He relies on them heavily in his swing trading strategies. They're basically a set of risk measures that help you understand how various factors impact an option's price. We'll decode four primary Greeks today: delta, gamma, theta, and Vega.
Okay, 4 key ones. So if I'm trying to estimate my potential profit on a trade before I even jump in, where do I start? Is it delta?
Yes, delta is your starting point for that.
Yeah.
Delta measures the sensitivity of an options price to a $1 move in the underlying stock. So it helps you estimate that potential profit or loss.
Yeah.
For instance, Rosewag uses PYPL. If you have a PYPL $120 call option with the delta of 0.42 and PYPL stock rises by $1, your contract would theoretically increase in value by $42.
Ah, okay. So it's a direct way to gauge the immediate impact of the stock moving on your option value?
Precisely. It tells you how much bang for your buck you get for each dollar move in the stock.
Got it. So delta tells you the initial speed, let's say. What about gamma? I sometimes hear that referred to as the acceleration.
That's a really great analogy for it. Gamma describes the rate at which delta itself changes. So if delta is your speed, gamma is indeed your acceleration.
Okay.
Using Rosewag's example again, let's say TOBP, Molson Coors, a $55 call might have a delta of 0.33 and a gamma of 0.08.
Right.
If TAP stock rises by $1, your contract initially gains $33 because of delta. But for the next $1 move upwards, gamma gets added to delta. So now your contract would increase by $41. That's the original $32, plus the $8 from gamma.
Wow, okay.
And it keeps going like that, creating that accelerating profit effect if the stock moves strongly in your favor. This is why knowing gamma is so vital, especially if you're anticipating a big, fast directional move.
So delta for that initial movement, gamma for how quickly that movement accelerates. Now, the one that always makes option buyers a bit nervous, theta. That's the infamous time decay, isn't it?
It is,
Yeah.
and it's often the option buyer's biggest nemesis, you could say. Theta represents the daily depreciation of an option contract. Literally, it's time decay. The closer an option gets to its expiration date, the faster its value erodes due to theta.
Like melting ice.
Exactly like melting ice. Rosewag provides a pretty stark example with a theoretical Force-hour or Meta $220 call. It might have a theta of negative 0.25.
Okay.
This means you'd lose $25 in value every single day you hold that contract, just from the passage of time, even if the stock price doesn't move an inch.
Ouch. So over a weekend.
Hold it over a weekend, Friday close to Monday open, and you
Oh.
could automatically be down $50 by Monday morning just due to theta decay. This is precisely why swing traders who, hold contracts for days or even weeks often choose further dated expirations. Longer time until expiry generally means lower theta, less daily decay.
That's a critical factor for anyone holding options for more than a few hours. And finally, Vega. That sounds like it ties into market sentiment, maybe volatility.
It absolutely does. Vega measures an option's price sensitivity to changes in implied volatility, or FOR. Now, FOR itself is basically the market's expectation of how much the stock's price might move in the future. Higher expectations mean higher FOR, and consequently higher option premiums. They get more expensive.
Right.
Rosewag illustrates this with a hypothetical CBS $110 call. Let's say it has a Vega of 0.10, 0.10, and the current 5E is 21.0%. If the IV increases by just 1%, maybe due to upcoming earnings or news, your contract gains $10 in value from Vega alone.
Okay.
However, if the IV drops, maybe the expected volatility decreases, say it drops to 15.10%, you'd lose $60 just from that change in IV.
So it cuts both ways.
It does. And for swing traders, Rosewag often advises against buying contracts with super high IV. Because if the stock price drops, you lose money from delta, right? But if the IV drops with the stock price, which often happens after big events like earnings.
Then you get hit twice.
Exactly. Your losses are compounded by Vega. It's that potential double whammy if you're not careful managing IV exposure.
So just to quickly recap the Greeks, delta tells you how much an option moves per dollar in the stock. Gamma, how quickly that movement accelerates. Theta is that daily time decay, the melting ice cream. And Vega is sensitivity to implied volatility, the market's expectation of future movement.
You got it. Understanding these helps you select the right contract for your strategy and risk tolerance.
But even with the perfect contract pick using the Greeks, you need to be able to actually get in and out of the trade easily. Liquidity matters, right? That's where volume and open interest come in.
Precisely. For options, volume and open interest are absolutely critical for assessing liquidity. High numbers in both mean lots of traders are active in that specific contract, that specific strike price and expiration date.
And that means tighter spreads?
Exactly. It leads to tighter bid-ask spreads. This is vital because it makes it much, much easier to get your trade filled at a favorable price, often near the midpoint between the bid and the ask price.
Okay.
Conversely, Low volume and low open interest result in very wide spreads, sometimes ridiculously wide. This makes it nearly impossible to enter or exit without immediately taking a loss because your purchase or sale itself can significantly move that midpoint price against you.
Right.
Think of it like trying to buy or sell a super rare collectible versus a common everyday item. The common item has tons of buyers and sellers, making transactions smooth and fair. The rare one, not so much. Much harder to find a buyer or seller at the price you want.
That's a powerful summary of the underlying mechanics. Options are complex. With those basics understood, though, you're ready to actually look at the stock chart itself. And that brings us to the visual language of the market. Candlesticks and their patterns.
Indeed. Candlesticks are really the fundamental building blocks of technical analysis. You're probably familiar with the basics, the green and red bodies, showing whether the stock closed higher or lower than it opened for that period.
Yeah, green up, red down.
And the wicks, or tails, those lines sticking out, indicating the high and low price reached during that period. Rosewag moves pretty quickly past these basics, though, to focus on a few select candlestick patterns that he finds offer powerful, actionable insights into market psychology and potential shifts in momentum.
Okay, let's look at some of those key patterns he highlights. What about the doji first? What does a doji candle signal, especially when Rosewag mentions its significance?
Right, the doji. It's characterized by a very small body, sometimes just a thin line, and often long upper and lower wicks. Essentially, this means the stock opened and closed at, or very near, the same price level during that period.
Indecision.
Exactly. It signifies uncertainty amongst traders. Neither the buyers nor the sellers were decisively in control. They're basically neutral, locked in a stalemate for that period. Rosewag stresses its significance, particularly when it appears at the end of a strong trend, suggesting a potential reversal.
Ah, a warning sign.
Yeah. For example, he points to a weekly doji that formed on the chart of $1 Dominion Energy right at the top of an uptrend. This visible indecision quickly led to a price reversal, and he notes it offered a clean entry to the downside once the price broke below the low of that doji candle. It's like a pause, a moment of doubt that often precedes a major shift in direction.
So dojis signal potential change through indecision. What about the engulfing patterns? Those sound quite decisive just from the name.
They are. An engulfing pattern visually represents a very strong, sudden shift in dominance between buyers and sellers. A bullish engulfing pattern occurs when a large green candle completely swallows or engulfs the body of the previous red candle.
Okay.
This indicates a sudden, strong surge of buying pressure, overwhelming the previous selling momentum. It suggests a potential reversal to the upside, or sometimes a powerful continuation of an existing uptrend.
And the opposite for bearish engulfing.
Exactly. A bearish engulfing pattern features a large red candle that completely swallows the body of the preceding green candle. This signals strong selling pressure taking control, indicating a potential downside reversal or continuation. Rosewag shows an example where AMZN, Amazon, dropped significantly after a doji appeared, followed immediately by a bearish engulfing pattern. That combination highlighted a powerful shift in control from buyers to sellers.
That's a very clear visual of a change in momentum. So dojis represent indecision, potentially preceding a shift, while engulfing patterns show a decisive change in control. These patterns, though just a starting point, really offer a rich language for interpreting market sentiment and spotting potential turning points.
Absolutely. And that deep understanding of individual candles helps build toward identifying broader market movements, the bigger picture.
Yeah.
So now we're kind of moving from reading those individual candle stories to understanding the narrative of the market as a whole, identifying stock trends and the crucial concepts of support and resistance.
Right. So stocks aren't just bouncing around randomly all day. They generally tend to move in discernible patterns or trends, correct?
Precisely. Rosewag breaks down stock movement into three primary ways: an uptrend, a downtrend, or consolidation. And his approach here is really rooted in multi-time frame analysis. This is key to his method.
Okay, how does that work?
He advises starting with the monthly chart. Look at the big picture first to grasp the major trend. Is it generally going up, down, or sideways over the long term? Then you move down to the weekly chart for the minor trends within that major trend. And finally, you zoom into the daily chart to spot other trends or shorter-term movements that are more relevant for immediate decisions, like entries and exits.
Layering the analysis.
Exactly. This layered approach helps traders make, well, highly educated decisions, whether they're swing trading or day trading.
So just to define them quickly, an uptrend is characterized by higher highs and higher lows. Price keeps making new peaks, and the pullbacks stop at higher levels than before.
Correct, like climbing stairs.
And the downtrend is the opposite. Lower lows and lower highs. Price keeps falling to new lows, and the bounces fail to reach the previous peaks.
Like falling downstairs.
And consolidation is sort of a sideways movement stuck in a narrow range where the trend is undecided. What's the core insight from Rosewag when it comes to how these trends actually change? It's not just an instant flip, is it?
No, definitely not. It's typically a two-step process, not an abrupt switch. For an uptrend to reverse into a downtrend, the stock must first fail to make a new higher high. Instead, it sets a lower high. That's the first clue, the first warning sign.
Okay.
Then, crucially, it must break below the previous significant low, establishing a lower low. If both of those things happen, a lower high followed by a lower low, the uptrend is likely reversing.
Makes sense.
And the inverse applies for a downtrend reversing into an uptrend. It needs to first make a higher high, breaking above a previous peak, and then make a higher low on the subsequent pullback, showing buyers are stepping in at a higher level than before. He shows CAC dollars, Coca-Cola, transitioning from a downtrend starting back in 2008 into a multi-year uptrend, illustrating this gradual but clear shift. Understanding this process is critical for not getting caught on the wrong side of a major market turn.
That's a vital observation. Trends don't just magically flip on a dime. Now, let's talk about mastering support and resistance. These are arguably the most fundamental concepts in all of technical analysis, wouldn't you say?
They truly are. Support and resistance levels are basically price points, where the stock's direction has a high probability of changing, or at least pausing. Support is a price level where buying interest is historically strong enough to prevent the price from dropping further.
Like a floor.
Exactly, like a price floor.
Right.
Imagine Bitcoin at $30,000, an example Rosewag uses. Each time it dropped to this level over a period, buyers consistently stepped in, absorbing the selling pressure and pushing the price back up. Now, the more times a price level holds the support, the stronger and more significant it becomes. This is largely due to trading psychology.
How so?
Well, if millions of traders around the world see Bitcoin repeatedly bounce off $30,000, what are they likely to do the next time it approaches that level?
They'll probably try to buy there again.
Exactly. They'll likely place buy orders there, creating this self-fulfilling prophecy of buying pressure. Rosewag shows Bitcoin's multiple bounces off that $30,000 level, which eventually led to a massive rally of over $25,000. That's the power of a well-established support level.
And resistance is just the mirror image of that, right? A ceiling.
Precisely. Resistance is a price level where selling pressure is historically strong enough to halt price increases. Similar to support, repeated rejections from a resistance level strengthen it. Why? Because traders who bought lower see the price stalling there again and decide to take profits. Sell. Others who might be shorting see it as a good place to initiate sells. Longs might liquidate their positions out of fear of another drop. Rosewag illustrates this with Costco, rejecting the $385 level an incredible 13 times over several months before finally breaking through.
Wow, 13 times. That's strong resistance. So what's the magic that happens when a stock finally breaks one of these significant levels, like Costco eventually breaking $385?
That's where things get really interesting and where big opportunities often lie. When a stock decisively breaks through a significant resistance level, that former resistance often transforms and becomes a new support level on subsequent pullback. Conversely, when a stock breaks below a strong support level, that former support often becomes new resistance on any bounces back up. This phenomenon is, again, deeply rooted in trading psychology.
Explain that psychology part.
Well, think about it. Let's say a stock breaks above resistance. Smart traders, or maybe those who hesitated, often miss that initial breakout move. But instead of chasing the price higher, which is risky,
Right.
they patiently wait for a retest of the breakout point. They want to see the price come back down and touch that old resistance level. If it holds there, bouncing off it, it confirms that the previous resistance has now flipped into new support. This retest offers a much low-risk entry compared to chasing the initial breakout.
Waiting for confirmation.
Exactly. Rosewag demonstrates this dynamic beautifully with Caristy's explosion after breaking $385 resistance. It likely became support later. And he shows AMD's $34 resistance turning into solid support after it was broken. It's a classic high-probability setup that traders look for constantly.
That's crucial for understanding where to potentially enter and exit trades. Now, Rosewag manually plots these support and resistance levels, emphasizing that multi-time frame approach, again, monthly, weekly, daily, trying to hit as many wicks or price extremes as possible for swing trading. But for day trading, There is an even more granular emphasis, isn't there? Specific daily levels.
Yes, absolutely. For day trading, while the longer-term levels still provide context, the critical insight Rosewag shares is that the previous day's high, low, and close will act as support and resistance. These levels become magnets for price action, especially early in the trading day.
Why those specific levels?
While the previous day's high and low represent the extremes where buyers or sellers respectively showed strength, the previous day's close is especially potent because, as Rosewag explains, it's the point where buyers and sellers agreed on a price to end the day. It's a psychological equilibrium point. This collective agreement makes it a powerful level, often dictating pre-market and early morning price action. He shows clear examples of TSLA bouncing right off the previous day's high, treating it as support, or Fiat Ballers using its previous day's low as support before eventually breaking it. And you can often see the previous day's close acting as critical support or resistance in the pre-market session, setting the tone for the open.
So we've covered static support and resistance plotted manually, and also these key daily levels for short-term trading. What about automated ways or more complex variations for finding these important price points?
Great question. Rosewag doesn't just rely on manual plotting. He incorporates advanced tools, starting with Person's pivots. He credits John Person, founder of Person's Planet, for this indicator.
Okay, Person's pivots, how do they work?
Essentially, Person's pivots automatically draw predetermined support and resistance areas on your chart based on the previous period's price action, high, low, close. The calculation is relatively simple for the main pivot point, just high plus low plus close, but the indicator plots multiple support, S1, S2, etc., and resistance, R1, R2, etc., levels derived from this.
And are they accurate?
Rosewag highlights their almost pinpoint accuracy. He shows examples on CRM Weekly and BD Hours and $5 intraday where price reacted precisely at these automatically generated pivot levels. His own setup is quite comprehensive. He uses daily, weekly, quarterly, and even options expiration Person's pivots layered on his chart, color-coded for clarity, to achieve maximum accuracy in identifying potential turning points and targets.
That sounds very useful, automating some of that level identification. Now, another major tool he discusses is Fibonacci. This comes up a lot in trading. How does he use Fibonacci extensions and retracements?
Fibonacci. Named after the Italian mathematician, it's a fascinating tool derived from that famous number sequence found throughout nature. Rosewag uses it in two main ways: extensions and retracements.
Let's start with Fibonacci extensions. When would you use those?
You primarily use Fibonacci extensions when a stock breaks into all-time highs or new recent highs where there's no historical price data to define resistance levels.
Yeah.
You've got blue sky above, basically.
Okay, so you need to project potential targets.
Exactly. You plot the extension tool from a clear recent swing low up to a swing high, and then often back down to a subsequent low, or vice versa in a downtrend. The tool then projects key extension levels upwards. Rosewag focuses on the 1.272 or 1.27.2%, 1.618, 106.1.8%, 2.618, and 4.326 levels. These act as potential price targets where the move might stall or reverse. He shows examples like QCOMM hitting the 137.2% extension perfectly.
And he mentions Fibonacci gaps. What's the significance there?
This is a concept Rosewag emphasizes strongly. A Fibonacci gap is the free space or distance between two significant Fibonacci extension or retracement levels. The idea is that once price breaks through one fib level, there's often little resistance until the next fib level, creating a gap that the market favors filling.
Why does the market favor filling it?
Again, trading psychology plays a role. Millions of traders are watching these same Fibonacci levels. When one breaks, they anticipate the move to the next level, creating collective buying or selling pressure that helps propel the price across that gap. Rosewag shows some really powerful examples, particularly with mRNA during its massive run-up. It repeatedly smashed all-time highs and then rapidly filled huge gaps between Fibonacci extension levels like $269 to 344s, then $304 to $340, then $304 to $360, and so on, offering substantial profits for those who traded the gap fills. He calls these gaps your market friend.
Wow, that sounds like a high probability setup. So extensions are for projecting targets in new territory. What about Fibonacci retracements?
Retracements are used after a stock has made a substantial run-up or drop in price. You use them to identify potential low-risk entry points during pullbacks or bounces within the prevailing trend.
So finding spots to get in during a pullback.
Exactly. For an uptrend, you plot the retracement tool from the recent swing low up to the recent swing high. The tool then shows key percentage pullback levels below the high, typically the 0.382, 38.2%, 0.50, 50%, and 0.618, 21.8% levels are most watched. Traders look for the price to pull back to one of these levels and find support before potentially resuming the uptrend.
Any examples?
Yeah, he shows $5, Visa, retracing exactly to the 50% level before bouncing strongly to new highs. And gold, retracing precisely to the 61.8% level, forming a double bottom there before rallying significantly. For downtrends, you plot high to low, looking for bounces up to these retracement levels to potentially enter short positions.
But what if price doesn't hold at a retracement level?
That's also critical information. Rosewag provides a cautionary tale with NAIO. It pulled back, but then broke below the key 61.8% retracement level. This failure to hold the fib support signaled that the prior uptrend was likely over, potentially indicating a larger trend reversal. So invalidating a fib level can be just as important a signal as holding one.
That's a really comprehensive look at static and mathematically derived levels. So we've covered manual SR, pivots, and fibs. Now let's move into dynamic indicators, the ones that move with the price. Starting with moving averages, these sound like they're always adapting to the market flow.
They are indeed. Moving averages are essential dynamic trend guides. Rosewag primarily uses exponential moving averages, or EMAs, especially for shorter-term trading. Why? Because EMAs give more weight to recent price action, making them more responsive to current market conditions.
How does that compare to simple moving averages, SMAs?
SMAs, in contrast, weigh all data points in their calculation period equally. This makes them smoother but slower to react, so they're often considered better suited for identifying longer-term trends. Rosewag uses both, but for dynamic support resistance and trend following, he focuses on specific EMAs derived from the Fibonacci sequence, the 5, 8, 21, and 55 EMAs. Each of these acts as a potential dynamic support or resistance level that moves along with the price.
Okay, so the 5 EMA being the shortest, sounds like it would be incredibly responsive, almost hugging the price.
It is. Rosewag describes the 5 EMA as a sticky average that price often rides during strong trends. In a powerful uptrend, the price will consistently bounce off or stay just above the 5 EMA. In a downtrend, it will stay below it. He shows compelling examples where stocks like B-Dollar, Boeing, and Square Block followed their respective 5 EMAs almost perfectly for extended periods, offering significant potential profits if you just held the trade and used the 5 EMA as your guide.
But price can't hug it forever, right? What happens when it pulls away?
That's a key insight he shares. When the price gets overextended, meaning it moves too far, too fast away from the 5 EMA, it tends to snap back, pull back towards the EMA, or at least consolidate sideways for a bit to let the EMA catch up. This isn't necessarily a signal that the entire trend is reversing, but it's a crucial warning sign. It suggests momentum might be temporarily exhausted, and it might be prudent to take some profits or wait for a better entry closer to the EMA rather than chasing the extended price.
Makes sense. Don't chase extremes. Now, what about the 21 EMA? Rosewag apparently calls this the mean and, quite boldly, the best possible spot to enter a trade. That's a very strong claim. Why the 21?
It is a strong claim, and he provides ample chart evidence to back it up. The 21 EMA is widely considered the mean or average price reversion point for a stock. Price almost always tends to gravitate back towards it. Because so many traders, both retail and institutional, watch and use the 20 or 21 on LASMA, significant price action buying or selling pressure is expected when the stock approaches this level.
So it acts like a magnet.
In a way, yes. This makes pullbacks to the 21 EMA in an uptrend, or bounces up to it in a downtrend, fantastic potential low-risk entry points. He recounts a really impressive personal trade on BLNK, Blink Charging, leaps those long-term options. He held them through a stomach-turning 40% daily loss at one point. Why? Because the weekly 21 EMA held firmly as support throughout that volatility. His patience, trusting that key weekly level, ultimately yielded over a 1,000% return on the trade.
Wow. That really underscores the power of that level, especially on higher time frames.
Absolutely. It highlights both the reliability of the 21 EMA for precision entries and the critical importance of that multi-time frame analysis we keep mentioning.
Okay, so the 21 EMA is a key spot for entries, and the shorter 5 and 8 EMAs are maybe better for managing the trade once you're in, riding the trend.
And that's generally how he uses them, yes. The 5 and 8 EMAs help you stay with the short-term momentum.
What about the 55 EMA then? That sounds like a more significant, perhaps slower-moving, longer-term dynamic level.
It is. The 55 EMA acts as a major support and resistance level across various timeframes, daily, weekly, even monthly. Its significance truly shines on the weekly timeframe, acting as a major historical barrier or floor. Rosewag recounts his swing trade on dollar realty income. He noted the price had been denied by the weekly 55 EMA a remarkable 17 times over a long period.
17 times.
Yeah. So when a strong, bullish, engulfing candle finally broke decisively above that long-standing weekly resistance, that was his high-conviction entry signal. This example powerfully illustrates the strength of the 55 EMA, especially on higher time frames, as a level that price respects significantly.
So EMAs are dynamic, responsive, great for shorter-term trends and entries. Now, simple moving averages, SMAs. You said earlier these are more for longer-term confirmation, especially watched by big money traders. Which ones does he focus on?
Correct. Rosewag incorporates the 50 SMA, 100 SMA, and 200 SMA into his analysis, primarily looking at them on the daily time frame. These are the averages heavily monitored by big money traders and large institutions. They represent longer-term trend health and significant potential support or resistance areas.
And the 200 SMA is considered the most important, the granddaddy.
Yes, the 200-day simple moving average is often called the granddaddy of them all. It's arguably the most widely watched long-term moving average. Price action around the 200 SMA is considered highly significant by institutions. What's truly fascinating, as Rosewag points out, is how price action around the 200 SMA sometimes seems to confirm major news before it's even officially announced.
How could that happen?
He suggests it happens because insiders, who might be privy to upcoming positive or negative news, make trades based on that information before it becomes public. This buying or selling pressure influences the price action, often causing the stock to respect or break the 200 SMA in anticipation of the news. He provides a compelling example with JP Morgan Chase, which had a solid close above its 200 SMA 2 days before a huge gap-up occurred on positive news. The chart was hinting at strength before the headlines hit.
That's a clever way to potentially read between the lines, looking for hints of hidden influences. So, the overall strategy for SMAs is to plot these levels, 50, 100, 200, on your daily chart when the price is near them, maybe color code them, but then actually remove the moving average lines themselves to keep the charts clean.
Precisely. You draw horizontal lines at the current level of the SMA of prices nearby, label them, for example, 200 SMA level, and then hide the actual moving average indicator. You get the benefit of acknowledging these powerful institutional levels without cluttering your visual field. The core principle, as Rosewag states repeatedly, is to let the moving averages do the storytelling. If the price is holding above key MAs, the story is generally bullish. If it's consistently below them, the story is bearish. He illustrates this synthesis by showing how ORCL, or Oracle, after a big earnings gap down, saw the 50 SMA and 21 EMA act as significant resistance. But once it broke above them, a buy signal was generated using the 58 EMA cross, allowing a profitable multi-day ride just by following the AEMA.
That's a really comprehensive approach to understanding trend and dynamic support resistance using both EMAs and SMAs. But to truly assess the health of a trend and spot potential reversals, you also need ways to measure momentum and identify those turning points, right? Let's move on to stochastics and the TTM squeeze.
Absolutely. We're now diving into indicators that help gauge the strength and speed of price movements, the momentum, as well as providing signals for potential exhaustion or reversals. The stochastic oscillator, developed way back in the 1950s by George Lane, is a momentum indicator. Rosewag finds it offers more accurate buy and sell signals compared to some other common oscillators like MEXID or RSI.
How does it work? What are the key levels?
It measures a stock's closing price relative to its high-low range over a specific period. The key readings are 20, which represents potentially oversold conditions, prices near the bottom of its recent range, and 80, representing potentially overbought conditions, prices near the top of its recent range.
And how do you get buy or sell signals?
The indicator has two lines, per K and per ST. A buy signal typically occurs when the faster per KC line crosses above the slower per T line, especially if this happens at or below the 20 oversold level. A sell signal occurs when per K crosses below per T, particularly if it's at or above the 80 overbought level. Rosewag mentions he prefers the stochastic slow version, which smooths the lines a bit, resulting in fewer signals, but he finds them to be more accurate. He primarily uses it on daily and weekly time frames for swing trading.
Okay, so it's about identifying these extreme overbought, oversold conditions and looking for crosses. But I'm guessing you can't just blindly follow every single signal, right? There must be context.
You absolutely cannot. This is where the crucial element of confirmation comes back into play, a recurring theme in Rosewag's work. He stresses the need to always confirm stochastic signals with the moving averages we just discussed. For instance, if stochastics generates a buy signal from the oversold zone below 20, but the stock price is trading below all the key moving averages like the 21, 55, 200, you should probably ignore that buy signal. The overall trend context is still bearish.
Makes perfect sense. Trend is king.
And signals on higher time frames are also considered superior. A weekly stochastic sell signal, for example, should always carry more weight and override a conflicting daily buy signal. You prioritize the longer-term message.
Okay, confirmation is key. Now, stochastics can also help spot something called divergences. What exactly is a divergence, and why is it so important for potentially spotting impending reversals before they happen?
A divergence is a really powerful concept. It occurs when the stock's price is moving in one direction, but the momentum indicator, in this case stochastics, is moving in the opposite direction. This discrepancy hints that the current price trend might be losing steam and could be about to reverse. It's like an early warning system.
Do you give an example? Let's say a bearish divergence.
Sure. A bearish divergence occurs when the stock price is making higher highs, continuing to push upwards, but the stochastics indicator is simultaneously making lower sell signals, lower peaks in the overbought zone, or even lower buy signals. The crossover points are happening at lower levels. This indicates that even though the price is still climbing, the underlying momentum driving that climb is weakening. It's like an engine sputtering, even as the car manages to inch further uphill. Rosewag considers this a strong warning sign to do not go long, or to at least be very cautious and consider taking profits on existing longs. He shows this XPY index exhibiting bearish divergence right before a significant pullback.
Okay, weakening momentum despite higher prices. And a bullish divergence would be the mirror image, signaling a potential upside reversal.
Correct. A bullish divergence happens when the stock price is making lower lows, still in a downtrend, but the stochastics indicator is generating higher buy signals. Crossovers happening at higher levels in the oversold zone, or maybe higher sell signals. The troughs in the indicator aren't going as low as before. This suggests that even though the price is still falling, the selling pressure is exhausting and underlying buying momentum is secretly starting to build. It hints at an impending reversal to the upside. Rosewag illustrates this with the GOOGL alphabet exploding upwards after showing higher buy signals on the stochastics during a period of price consolidation near the lows.
That's incredibly insightful for anticipating major shifts, catching turns early. Now, let's move to that indicator you highlighted earlier as the author's favorite, the TTM Squeeze. What makes this one so special?
The TTM Squeeze, developed by John Carter of Simpler Trading, is a truly dynamic indicator that Rosewag relies on very heavily, especially for identifying potential breakout moves. It cleverly combines three other indicators: Bollinger Bands, Keltner channels, and a momentum oscillator, all into one visual tool. Its main purposes are to identify periods of positive or negative momentum and, crucially, to signal when a stock is consolidating and potentially building energy for a significant breakout.
Okay, it has that histogram at the bottom, right?
Yeah.
Different colors.
Yes. The histogram is the momentum gauge. It uses four colors. Light blue indicates strong, increasing buying momentum. The bars are typically getting taller. Dark blue shows that buying momentum is still present but starting to fade or die down. Bars getting shorter. This is often an ideal time to consider taking profits on long positions. Red signals strong, increasing selling momentum. Red bars getting taller or deeper. Yellow indicates selling momentum is dying down. Buyers might be stepping back in. Yellow bars getting shorter. This often precedes a flip back to light blue. Rosewag shows examples on ADSK and AAPL where the price action correlates very closely with these histogram color changes.
So the histogram shows momentum. How does the squeeze part itself work? What's actually happening mechanically when those color dots appear on the zero line?
Right. The dots signal the squeeze. A squeeze occurs mechanically when the Bollinger Bands, which measure volatility, curl inside the Keltner channels, which also relate to volatility and average true range. This signifies a period of unusually low volatility and consolidation where the price is coiling up, building energy like a compressed spring, potentially for a significant directional move once volatility expands again.
Okay, and the different colored dots tell you the status of that squeeze.
Exactly. The TTM squeeze uses different colored dots along the zero line of the histogram. A red dot signals the squeeze is active. The Bollinger Bands are currently inside the Keltner channels. The spring's being compressed. An orange dot is rarer and indicates an even tighter squeeze. The bands are further inside the channels. This implies even greater coiled energy, potentially leading to a more explosive move. Rosewag notes this is often his earliest potential entry signal, anticipating the eventual release. A black dot means the squeeze is in its first stage of firing. The Bollinger Bands are just beginning to curl back outside the Keltner channels. The spring is starting to release. And finally, a green dot signifies that the squeeze has officially fired. The bands have fully dispersed, volatility has expanded, and the stock is now moving freely, hopefully with strong momentum indicated by the histogram.
So that orange dot signals the tightest compression, the most potential energy. How does Rosewag typically trade this? Does he wait for the green dot fire?
Interestingly, he often aims to enter positions during the orange dot squeezes, or sometimes the red dot squeezes, if other confirmations align. His goal is to get positioned before the big move happens, catching the huge E move when it eventually fires through the black and green dots. He shares a compelling example of BJ's wholesale running strongly from $38 up to $50 after consolidating with an orange dot squeeze. He wants to be on board for that explosive release of energy.
Positioning early for the pop, does it only signal upside moves?
No, squeezes can resolve to the downside too. He shows an example of GLD, gold ETF, having a weekly squeeze that broke a key trend line and resolved downwards initially, leading to a plus 120% return on put options for those positioned correctly. He also emphasizes a specific pattern called the slingshot squeeze, where price consolidates in a squeeze, then breaks decisively above or below key moving averages, and then slingshots powerfully in the direction of the momentum, as seen in a nice AAPL rally from $126 to $150 after a squeeze release coincided with a break above MAs.
That's incredibly powerful for timing entries before major breakouts or breakdowns. What's the paramount rule, the absolute must-do, when combining the TTM squeeze with other indicators like moving averages?
The paramount rule, which Rosewag emphasizes repeatedly throughout the book, is confluence is key. You absolutely must always combine the TTM squeeze signals, both the dots and the histogram, with the context provided by moving averages and support resistance levels.
So don't trade it in isolation.
Never. For example, if the TTM histogram is bright light blue, showing strong buying momentum, but the stock price is trading below all its key moving averages, like the 21 and 55 EMA, you should probably avoid taking calls based on the squeeze alone. The overall trend context is still weak.
Right.
Conversely, if the histogram is red, showing selling momentum, but the stock is bouncing off strong support and holding above its key moving averages, you should likely avoid puts. This disciplined approach of demanding confluence ensures you're trading with the broader technical picture and not just chasing a single indicator signal against the prevailing tide.
That's a really solid warning against relying on any single indicator in a vacuum. Confluence is everything.
Okay, so we have momentum indicators covered. Now let's talk about confirming true strength and weakness in a move using on-balance volume, OBV, and then diving deeper into mastering key chart patterns.
Exactly. On-balance volume, or OBV, developed way back in the 1960s by Joseph Granville, is essentially a momentum indicator that measures cumulative money inflow versus money outflow. It adds volume on up days and subtracts volume on down days.
Why is it particularly relevant now in what Rosewag calls the new age of technical analysis?
He highlights its crucial modern relevance because, these days, traditional volume analysis on a stock chart can be complicated. Why? Because the massive volume traded in the options market isn't directly reflected in the stock's actual share volume bars you see on the chart.
Ah, okay, so stock volume might look low, but there could be huge activity in options. Precisely. OBV, by accumulating volume based on price direction, can help you spot significant buying or selling pressure, that smart money flow, even when the normal stock volume bars might appear deceptively low or average. It gives you a potentially clearer picture of accumulation or distribution. He prefers to use OBV on daily and weekly charts, finding the signals clearer and less choppy than on smaller intraday timeframes.
So it's kind of like a smart money detector that can often lead the actual price movement.
In many ways, yes. OBV itself can exhibit uptrends, downtrends, consolidations, break support or resistance, and even show divergences, often before the stock's price chart does the same thing. It can give you an early heads up.
Can you give an example of OBV leading price?
Sure. He cites Cessno Animations, Snowflake, where its OBV indicator broke its downtrend line and started setting higher highs and higher lows well before the actual stock price confirmed a bottom and reversed upwards. The OBV was signaling accumulation first. Similarly, he shows ADBV, where the OBV broke out of its consolidation range before the stock price did, hinting strongly that an upside price breakout was likely imminent, which then occurred.
So it acts as a confirmation or even a leading signal for breakouts.
Yes, Rosewag concludes that OBV is a very reliable and accurate indicator, especially for confirming the validity of potential swing trades when viewed on those higher time frames, daily and weekly.
That's a compelling argument for adding OBV to the toolkit. Now let's talk about mastering chart patterns. You've mentioned a few already, like flags and head and shoulders. How critical are these visual patterns for identifying buy-sell signals and potential price objectives?
Chart patterns are absolutely critical in Rosewag's methodology. He emphasizes their paramount role. These patterns are visual representations of collective market psychology, buying and selling battles, that tend to repeat themselves across all assets and timeframes. Recognizing them allows traders to anticipate potential future price movements and set logical price targets. And importantly, patterns identified on higher time frames, like weekly or monthly, generally lead to bigger and more significant price reactions than the same pattern on a 5-minute chart.
Okay, let's focus on a few of Rosewag's most essential patterns that he details. Starting with a common continuation pattern, the bull flag. What does it look like and how is it traded?
A bull flag is a very powerful bullish continuation pattern. It typically appears after a sharp, strong price increase. That vertical move forms the flagpole. This is then followed by a period of brief, orderly consolidation or pullback, usually drifting slightly downwards or sideways within parallel lines. This forms the flag. Visually, it genuinely often resembles a flag hanging on a pole.
Okay, flagpole, then the flag. And it suggests the uptrend will continue.
Exactly. It's a pause that refreshes, suggesting the prior uptrend is likely to resume. Now, for entry strategy, Rosewag actually suggests considering entering during the consolidation phase, within the flag itself, rather than waiting for the breakout above the flag.
Why enter early? Isn't that riskier?
His reasoning is that since it's a high-probability continuation pattern, entering during the consolidation often allows you to get in when implied volatility on options is lower, making the premiums cheaper. Plus, your stop loss can be placed tightly, perhaps just below the lower trend line of the flag or below a key short-term EMA like the 8 EMA. He shows intraday examples on TSLA where entries taken off the lower flag trend line or bounces off the 8 EMA within the flag led to profitable moves when the trend resumed.
Interesting approach. How do you estimate a price target?
A common method, which Rosewag notes is maybe a 50-50 technique but still helpful, is to measure the height of the initial flagpole, the sharp rise, and then project that same distance upwards from the point where the price breaks out of the flag consolidation. It gives you a rough objective.
Okay, so bull flag for upside continuation. What about the head and shoulders pattern? You mentioned it earlier. That's a classic reversal signal, right? It signals a top.
Indeed. The head and shoulders H&S pattern is widely considered one of the most reliable bearish reversal patterns. It primarily occurs at the peak of a significant uptrend and signals a likely shift from bullish to bearish sentiment. It consists of 3 peaks: a left shoulder, followed by a higher peak, the head, and then a lower peak, the right shoulder. These peaks are all connected by a support line called the neckline.
And volume is important here.
Volume confirmation is absolutely critical for a valid H&S pattern. You typically expect to see decent volume on the rally, forming the left shoulder. Then, the volume on the rally forming the head should ideally be equal or less than the left shoulder's volume. This is a subtle warning sign that buying enthusiasm might be waning despite the new price high. Finally, the volume on the rally forming the right shoulder should be significantly weaker than the previous 2 peaks. This declining volume confirms that buyers are losing control.
Okay, declining volume on the way up. When do you actually enter a short trade?
The standard entry signal is to wait for the price to break and close below the neckline support level. Break in the neckline confirms the pattern and the shift in control to sellers. The inverse head and shoulders, of course, is its bullish counterpart found at the bottom of a downtrend, signaling a potential reversal to the upside, and you'd look for the opposite volume characteristics, ideally increasing volume on the right shoulder and the breakout above the neckline.
Got it. Classic reversal patterns. Finally, let's touch on the cup and handle pattern. That sounds like a more gentle, perhaps more prolonged continuation pattern.
It generally is, yes. The cup and handle is typically a bullish continuation pattern, often forming after a prior uptrend. It looks, well, like its name suggests, a rounding bottom formation that creates the cup, followed by a shorter, typically shallower pullback or consolidation period that forms the handle.
So a U-shape, then a little drift down.
Exactly. It signals a period of consolidation and base building after a run-up, before the uptrend potentially resumes. The entry signal is usually triggered when the price breaks decisively above the resistance level formed by the top of the handle. Rosewag shows examples on charts like LYFT and PITS-PNS where completed cup and handle patterns led to significant subsequent upward moves. It's often seen as a pattern requiring patience, but one that can lead to powerful breakouts.
As a truly powerful overview of how these chart patterns literally tell a story about the battle between buyers and sellers. It's clear that by understanding these visual cues, traders can gain a significant edge in anticipating market moves. Okay, now let's bring it all together. How does Rosewag integrate all these tools, the Greeks, the candlesticks, SR, fibs, MAs, momentum indicators, OBV, and chart patterns, into a comprehensive swing trading strategy? This sounds like where the magic happens.
This is indeed where all the individual pieces of the puzzle we've discussed come together into a coherent, actionable methodology. Swing trading, just to redefine it in his terms, involves holding options or shares for potentially days, weeks, or even months, aiming to capture those larger, more significant price moves compared to day trading. It's generally slower paced, which allows more time for thorough planning and analysis.
And what's his core indicator stack for swing trading? Does he use everything we've talked about?
He uses a very comprehensive set. His primary toolkit includes the 5, 8, 21, and 55 EMAs, the 50, 100, and 200 SMAs on balance volume, OBV, the stochastic slow oscillator, and the TTM Squeeze. He actually uses a great analogy. He says indicators are like filters on Instagram. You wouldn't just use one filter and expect the perfect picture, right? You often combine several filters, layering them to get the best result. Similarly, he layers these indicators, looking for confluence, multiple indicators confirming the same signal to build a high-probability trade setup. He also mentions using separate charts or chart layouts for different sets of indicators to maintain clarity and avoid visual overload.
That's a good tip. Keep it clean. Now, what kind of companies does he prefer for swing trading? I imagine everyone just wants to swing trade the big, exciting tech names like Tesla or Nvidia.
Well, interestingly, he often finds better swing trading opportunities in less popular or perhaps less volatile names. He gives examples like $6 US Steel, J&J, Johnson Johnson, BDL, BG's Wholesale, or DLL, Gilead Sciences, often favoring them over the high flyers like TSLA or 5U or Meta for swing trades.
Why is that? What's the advantage?
The key insight here is multifaceted. First, the options contracts on these less hyped names are typically much cheaper in terms of premium. Second, they often offer high delta and gamma relative to their premium, giving you good leverage to the underlying stock's move. And third, crucially for swing trading, where you hold for time, they tend to have lower theta, time decay. This combination often leads to a much better overall risk-to-reward ratio compared to paying exorbitant premiums for volatile tech options. For instance, he notes an 6-DEXA contract might cost $120 for a month out, whereas a comparable few dollar contract could easily be $500, $900.
That makes a huge difference in position sizing and risk.
Absolutely. And for expiration dates, he strongly recommends swinging options with monthly expirations, typically the third Friday of the month, rather than weekly ones, primarily due to their generally higher liquidity, volume, and open interest, and often more favorable theta decay profile for holding periods longer than a few days.
Okay, cheaper contracts, better risk reward, monthly expirations. Let's delve into one of his actual swing trade examples to see how this confluence he seeks plays out in practice. You mentioned a trade he took on $6 US steel that apparently had 10 different confirmations lined up. It sounds like an incredibly high bar to clear.
It is, and that's really the essence of his high-probability swing trading strategy. It's about waiting patiently for the A-plus setups where everything aligns. For his 6-devil call trade, he detailed an amazing 10 specific confirmations he identified before entering. 1. A clear daily bull flag pattern forming. 2. An even clearer weekly bull flag pattern forming, higher time frame confirmation. 3. Bullish EMA stacks on multiple time frames. 5. 821 EMAs aligned upwards. 4. Price holding above key longer-term weekly moving averages. 5. An OBV uptrend on both the daily and weekly charts, indicating smart money accumulation. 6. A stochastic buy signal generating from an optimal level on the daily chart. 7. Another stochastic buy signal confirming on the weekly chart. 8. The TTM Squeeze histogram showing momentum shifting from oranger dots consolidation to light blue, strong buying momentum taking over. 9. The squeeze dots themselves potentially firing or about to fire. 10. Favorable risk reward based on chart structure and potential targets.
Wow, 10 checks in the box.
Exactly. Based on this overwhelming confluence of evidence across patterns, indicators, and timeframes, he felt confident buying the $629 strike calls about a month out from expiration for a relatively cheap $120 per contract. This exemplifies the rigor of his confluence is key philosophy. He wants every indicator telling the same bullish or bearish story before committing capital.
That's incredibly thorough. It really drives home the importance, again, of that multi-timeframe analysis. You can't just look at the daily chart in isolation for swing trades.
Absolutely not. Rosewag strongly states that neglecting the higher time frames, monthly and weekly, is one of the most common reasons why traders lose money on swing trades. A setup might look great on the daily chart, but if the weekly chart shows major resistance just overhead or is in a clear downtrend, the daily signal is much less likely to succeed. All three time frames, daily, weekly, and ideally even monthly for context, should ideally show the same confirmation for what he calls a truly clean setup.
And higher time frame signals generally mean you need more time for the trade to play out.
Precisely. He advises that if your primary trade thesis is based on strong weekly or monthly chart signals, you should be using longer dated expirations on your options maybe several months out, or even considering leaps.
Leaps, those are the really long-term options, right?
Yes, leaps, long-term equity anticipation securities, are options contracts that expire a year or more out into the future. For trading these, Rosewag focuses almost purely on the weekly and monthly timeframes, essentially ignoring a short-term noise on the daily chart. His incredible BLNK trade we mentioned earlier, the one returning over the 1,000%, was structured using leaps based on weekly chart analysis, specifically holding the weekly 21 EMA. That higher timeframe conviction allowed him to weather significant short-term volatility.
That's the power of the higher time frame perspective. Now, beyond the standard indicators and patterns, he also talks specifically about trading gap fills as a strategy for swing trades. You mentioned the market favors filling gaps. Can you elaborate on that as a setup?
Yes, this is a powerful, almost psychological phenomenon that can offer high-probability trades. A gap on a chart occurs when the price opens significantly higher or lower than the previous day's close, leaving an empty space or gap in the price action. Rosewag notes these gaps often occur between key support-resistance levels or, as we discussed earlier, between Fibonacci levels.
And the idea is price tends to go back and fill that empty space.
Exactly. The market, as he puts it, favors filling the gap. Why? Partly technical, as gaps often occur to significant levels, but also partly psychological. Many traders see these gaps and anticipate them being filled. If it's a gap down, traders might look to buy, expecting a bounce back up to fill the gap. If it's a gap up, they might look to short, expecting a pullback to fill it. This collective expectation helps drive the price towards filling that empty space. He provides really powerful examples, especially with mRNA during its huge run, where it would gap up massively on news, often between Fibonacci extension levels, and then rapidly fill those huge multi-dollar gaps over the next few days, offering substantial profits for those positioned to trade the fills. It's a profound insight for identifying high-probability, often fast-moving directional opportunities.
That sounds like a pattern worth watching closely. Now, with all these potentially profitable strategies, managing risk remains paramount. He details using options spreads specifically for that purpose in swing trading. Can you quickly explain the purpose or benefit of using a spread versus just buying a simple call or put?
Absolutely. Spreads are crucial tools for proactively limiting your risk and sometimes even enhancing your potential reward, albeit often capping the maximum possible gain. They involve simultaneously buying one option contract and selling another related contract.
Okay, like a debit spread. How does that work?
A debit spread is very common. For a bullish example, a call debit spread. You'd buy a call option that's closer to the current stock price, maybe slightly out of the money or at the money, and simultaneously sell another call option with the same expiration date but at a higher strike price, further out of the money.
Why sell the higher strike call?
Selling that further OTM call brings in some premium, a credit. This credit partially offsets the cost of the call you bought, making your overall entry cost, the debit, cheaper than just buying the single call outright. The trade-off is that selling the higher strike call also caps your maximum potential profit if the stock really takes off, because your gains in the long call are offset by losses on the short call above that higher strike price. But the big advantage is that your maximum possible loss is strictly limited to the net debit you paid up front. It creates a very defined risk-reward scenario.
So, cheaper entry, defined risk, but capped upside. What about other types, like a calendar spread?
A calendar spread involves options with the same strike price, but different expiration dates. A common strategy is to buy a longer-dated option, for example, a call expiring in 3 months, and simultaneously sell the same strike call, but with a closer expiration date, for example, expiring next month. The goal here is often to profit from the faster time decay, Theta, of the short-term option you sold. You collect premium from selling the front-month option, which helps pay for the longer-dated option you bought, effectively making your longer-term bet cheaper.
Interesting way to use time decay to your advantage. And he also mentions the butterfly spread. That sounds complex.
It is a bit more complex, involving 3 different strike prices, but all with the same expiration date. A common call butterfly involves buying one in the money, ITM call, selling 2 at the money ATM calls, and buying one out of the money, OTM call. This structure creates a position that profits most if the stock price stays within a very specific, narrow range around the middle ATM strike price at expiration. It typically offers a very low entry cost, low risk, and potentially very high reward if the stock pins that sweet spot. A key benefit Rosewag highlights is that, if structured correctly, the positive theta from the two short options can often largely offset the negative theta from the two long options, making the overall position's time decay non-existent or even slightly positive while you wait for the potential move. He shares successful butterfly trades he made on AMD and CHWY using this strategy, combined with his usual technical confirmations.
That's a lot of sophisticated ways to structure trades and manage risk effectively for swing trading. So, to quickly recap the essence of Rosewag's swing trading, it's about longer holding periods, focusing heavily on higher time frames, weekly, monthly, for the main signals, demanding strict confluence across a wide range of indicators, MAs, stochastics, TTM, OBV, and patterns before entry, using SR, pivots, and Fibonacci for key levels and targets. And remembering that higher time frame signals warrant longer dated expirations, potentially using leaps or spreads to manage risk and cost, it's truly a holistic, patient, and confirmation-driven approach.
Exactly. That captures it perfectly. And while your carefully planned swing trades are developing over days or weeks, you can also navigate the much faster-paced opportunities that arise daily. This brings us to the final major strategy section, day trading, which Rosewag also covers extensively with its own specific set of rules and techniques.
Right, day trading, a whole different beast altogether, much faster, more intense. How does Rosewag approach determining the likely direction for these very rapid short-term trades? Does he use the same tools?
He uses many of the same tools, but the application and time frame focus shifts significantly. Day trading, by his definition, is about executing fast-paced, momentum-driven trades that can last anywhere from just a few seconds to maybe a few hours, aiming to profit from the small, short-term fluctuations within the trading day. And he emphasizes right away that risk management becomes even more critical due to the speed and frequency of trading.
Okay, so how does he get a directional bias for the day?
His initial step each morning is to determine the likely prevailing intraday direction using EMA stacks on higher time frames. He sets up a flexible grid chart layout, often showing the 1-hour, 4-hour, and daily charts side by side, and plots a specific stack of EMAs on them, the 5, 8, 21, 34, 55, and sometimes the 89 EMA.
And how does he interpret these stacks?
It's quite straightforward. If, on these higher time frames, all the EMAs are stacked neatly downwards, meaning the 5 is below the 8 is below the 21 below the 34, and so on, he calls this a bearish stack. This tells him the prevailing momentum is strongly downwards, and he should primarily be looking for opportunities to enter puts, short trades.
And the opposite for bullish.
Exactly. If all the EMAs are stacked neatly upwards, 5 above 8, 8 above 21, etc., that's a bullish stack. The momentum is clearly upwards, and his primary focus for the day should be looking for opportunities to enter calls long trades. This EMA stack analysis provides him with an ideal direction or strong bias for the trading day. The EMAs themselves then also act as potential dynamic support or resistance levels on the intraday charts. He often forms his initial morning bias based purely on these higher time frame EMA stacks.
So the EMA stack sets the directional stage for the day. Now, for the actual entry trigger, he talks quite a bit about the opening range breakout, or ORB, calling it his exact entry technique. What's his favorite variation of the ORB?
His absolute favorite ORB setup, the one he finds most powerful, occurs when 3 specific price levels from the previous session and pre-market all converge and reject the same price level. Specifically, when the previous day's high, the post-market high from the previous evening's after-hours session, and the current day's pre-market high all happen to stall out at roughly the exact same price.
Wow, 3 levels aligning perfectly.
Yes. This creates a formidable, multi-layered resistance point just before the market opens. A decisive breakout above this confluent level shortly after the market opens then generates what he calls double buying pressure. Why? Because you have buyers breaking the previous day's high and buyers breaking the pre-market high simultaneously. Many different traders using different reference points are all triggered to buy at the same time. He gives a great example with PFE, Pfizer rejecting the $50.50 area where all 3 levels converged multiple times before the open, and then running up $1.40 very quickly once it broke above that level after the market opened. This confluence of prior resistance creates a powerful springboard for a breakout.
That sounds like a very specific high probability setup to look for. What about the stop loss and profit taking for ORBs?
For stop loss, it's typically placed just below the low of the candle that breaks out above the opening range, or the key resistance level. As the trade moves in your favor, you trail the stop loss up, perhaps under a short-term moving average like the 8 EMA on a 5-minute chart. For taking profits, he advises exiting when the price gets significantly overextended from the 5 EMA or when it hits a predetermined resistance level or pivot point. And he strongly emphasizes, do not be greedy. Day trading is about capturing quick, high-probability moves, not trying to catch the entire day's range. Lock in profits when you have them.
Solid advice. Stick to the plan, manage risk. That sounds like a robust framework for establishing a daily bias with the EMA stacks and getting a precise entry with the ORB. Another relatively simple pattern he mentioned specifically for intraday trading is the ABCD pattern. How does that work?
The ABCD pattern is one of the easiest and most common patterns for day traders to identify and potentially trade. It's a simple geometric sequence of price movement, point A to point B. An initial sharp increase or decrease in price, the first leg of the move, point B to point C, a pullback or consolidation phase. Price retraces a portion of the AB move, point C to point D, another increase or decrease that often mirrors the length of the initial AB leg, potentially making a new high or low beyond point B.
Okay, AB is the impulse, BC is the pullback, CD is the next impulse. Where's the entry?
The key, according to Rosewag, is that point C, the end of the pullback, is your ideal low-risk entry point. He observes that point C often coincides with key support levels like the 8 EMA, the 21 EMA, or common Fibonacci retracement levels like the 50% or 61.8% retracement of the AB leg. He strongly emphasizes avoiding chasing the trade up at point B, where risk is higher, and instead patiently waiting for that pullback to point C to enter with a tighter stop loss. He illustrates this clearly with intraday examples on 6U and AMD, showing point C finding perfect support right at the 21 EMA before the next leg, CD launched higher.
That's a great simple pattern for newer traders to spot and practice patience with entries. Now, for something that feels a bit more high-tech and maybe intimidating, Level 2 data. What exactly is Level 2, and how does it help confirm a trade in real time?
Level 2 data, sometimes called market depth or the order book, provides a real-time dynamic view of all the current buy and sell orders for a specific stock across different exchanges or market makers. It shows the specific prices buyers are willing to pay, the bids, and the prices sellers are asking, the asks, along with the number of shares being offered at each price level, usually shown in lots of hundred shares.
So you can see the supply and demand stack in real time.
Exactly. It's incredibly helpful for confirming the strength of a breakout or signaling a potential reversal right as it's happening. You can literally spot large clusters of sell orders stacked at a specific price level, often called a sell wall, which could act as strong short-term resistance. Or you might see large buy orders stacked up a buy wall acting as support. Rosewag shows a screenshot of a significant sell wall appearing at $121.98 on PYPL's Level 2, suggesting sellers were numerous at that price.
Okay, so you can see these walls. What's the actionable insight? How do you use it to trade?
The key insight is to watch how the price interacts with these walls and, crucially, whether there's follow-through. For an upside breakout above resistance, you want to see buyers aggressively absorbing the shares offered at the ask prices and see new buy orders coming in to support the price. If price breaks a level but then stalls, and you see sellers replenishing the ask side on Level 2, the breakout might fail. Similarly, for a breakdown below support, you need to see sellers hitting the bids aggressively and buyers pulling their orders away. Waiting for price to decisively clear significant walls and seeing that immediate follow-through momentum on Level 2 helps prevent getting caught in false breakouts or breakdowns, often called head fakes.
So it's about confirming the intent behind the price move in real time.
Precisely. And you'd combine this with your overall directional bias from the EMA stacks. If you have a bullish stack, you'd prioritize looking for strong buyer activity and the clearing of sell walls on Level 2 to confirm long entries. Rosewag acknowledges Level 2 takes practice to read effectively and recommends checking out his Brandon Trades YouTube channel, where he has in-depth videos demonstrating how to interpret it live, as it's much easier to grasp visually.
That makes sense. It sounds like a skill developed over time. And for the absolute fastest moves, the quickest entries and exits, he talks about scalping. What's the strategy there?
Scalping is really about taking advantage of very small price changes, getting in and out of trades extremely quickly, often within seconds to just a few minutes. For scalpers, Rosewag says Level 2 data becomes your absolute best friend for spotting those fleeting opportunities and confirming entries instantly.
How does he approach scalping, say, right at the market open?
His favorite scalping strategy often takes place within the first 5 to 10 minutes of the market open, which is typically the most volatile period. The process is rapid. 1. Quickly determine the likely intraday direction using the higher timeframe EMA stacks, 1H, 4H daily. 2. Instantly mark key SR levels from the pre-market, previous day's high-low close, and any nearby pivot points or Fibonacci levels on your intraday chart. 3. Identify potential entry points, often breaks of the pre-market high-low or the previous day's high-low, like the ORB setups. 4. Drop down to very small time frames like the 1-minute or 3-minute charts for precise sniper entries. 5. Enter immediately on a confirmed break of your chosen level, crucially watching level 2 for that instant volume confirmation and follow-through. You do not wait for the 1-minute or 3-minute candle to close. 6. Place your stop loss just below the breakout candle for longs, or just above for shorts. 7. Trim profits quickly as the trade moves even slightly in your favor, and trail your stop loss aggressively.
Yeah, that sounds intense. Seconds matter.
They absolutely do. He shows an example of scalping NFLX right at the open. It broke above its pre-market high of $610. He entered immediately, confirmed by level 2, and it ran straight to $615.28 within just 3 minutes, netting a plus 27% gain on the options contract. Another example on DGS, Goldman Sachs, ran from $402 to $403.28 in only 1.5 minutes. The goal is simply to get in, catch the immediate momentum, and get out before the move potentially fades. It requires focus and decisiveness.
Definitely not for the faint of heart. Now, for day trading in general, whether scalping or holding a bit longer, what about the contracts and expiration dates he recommends? Is it different from swing trading?
Yes, it's very different from his swing trading advice. For day trading, his rule is generally to always trade the closest dated expiration, meaning the options contracts expiring that very same week, usually on Friday. Even if it is Friday, he still often trades those contracts expiring in just a few hours, calling it Lotto Friday.
Why trade contracts that expire so soon? Isn't the theta decay incredibly high?
It is. But for day trading, where you're only holding positions for minutes or maybe hours at most, that rapid theta decay is less of a concern compared to the benefits. The primary benefit is that these shortest dated options have the cheapest premiums. This allows you to potentially buy more contracts for the same amount of capital or risk less capital per trade. And crucially, these near-term options typically have the highest gamma, meaning they react most explosively price-wise to small moves in the underlying stock, leading to potentially higher percentage profits on successful quick trades. He shows an example comparing a weekly buy-deal option premium to a monthly one, highlighting the significant cost difference.
So maximize leverage and percentage gain potential for short holds. How does he choose the strike price for day trades?
He advises choosing strike prices that are close to the stock's current price and its expected short-term movement. For example, if a stock is breaking an ORB level at 202 cents and the next clear resistance level is up at 206 cents, you might choose the $202.50 or maybe the $205 strike call option for your day trade, keeping it relatively close to where the action is happening.
Okay, closest expiration, strikes near the expected move. Finally, for day trading, how do you consistently find good stocks to trade each day? How do you build your day trading watch list and then actually stick to a plan?
This is crucial for consistency. First, you need a core watch list of stocks that meet specific criteria suitable for day trading. He looks for stocks that typically move more than $2.50 to $3 per day on average, providing enough range, have very liquid options, tight spreads, high volume, and ideally offer some diversification across sectors, not just trading tech stocks all day. He aims for a manageable list of maybe 10 to 15 popular names that fit these criteria, stocks like AAPL, 5B, HEL, BAVAL, AMD, MVA, etc.
How do you find these names initially?
He suggests 2 main methods. Method 1. Use a free online stock screener like finviz.com. You can screen for criteria like market cap, medium large, mega, average volume, 1 million shares day, and ensure they are optionable. Then you can apply basic technical filters to find stocks already showing bullish or bearish characteristics, e.g., filter for stocks where the 20-day SMA is above the 50-day SMA for bullish ideas. This can quickly generate a list of potential candidates like COST, 2RM, GUL, DWGL, NSFT, etc. Remember to always double-check their options, liquidity specifically.
Okay, use a screener. What's method 2?
Method 2 is even simpler. Just look at the top 10-20 holdings of the major market indices like the S&P 500, SPY, NASDAQ Q100, QQQ, and Dow Jones 30 DIA. These lists contain the largest, most liquid, and most influential stocks in the market, which are almost always excellent candidates for day trading due to their volume and options liquidity.
So you build this core watch list of 10-15 names. How do you narrow it down each morning to decide what to actually trade that day?
This is where creating your daily plan comes in, usually done in the pre-market. From your core watch list of 10-15 stocks, you systematically analyze each one, looking for the 3 or 4 stocks that present the absolute best potential setups for that specific day. You use the tools we discussed, check the 1-hour, 4-hour, and daily EMA stacks for directional bias. Look for developing TTM squeezes or momentum signals. Identify clear chart patterns forming. Note key pre-market support resistance levels and the previous day's high-low close. You then take brief pre-market notes on your top 3-4 candidates, outlining potential entry triggers like ORB levels, price targets, and stop-loss points.
So you have a focus plan before the bell rings. And the most important part.
The most important part, he stresses emphatically, is to stick to your plan. Once the market opens, only take trades on those 3 to 4 stocks you identified, and only if they actually hit your predetermined entry triggers. If a stock on your list doesn't set up according to your plan, avoid it. Don't chase random moves or trade stocks that weren't part of your focused pre-market analysis. As he says, the stock market is not going anywhere. There will always be another opportunity tomorrow. Trading off plan based on impulse or FOMO, fear of missing out, is a very common way day traders lose money. He shows a TSLA trade example where he waited patiently for it to hit his pre-planned level before entering. Discipline is paramount.
Discipline and sticking to the plan. That seems to be a universal truth in trading. So whether it's the longer-term, patient approach of swing trading or the lightning-fast execution required for day trading, the emphasis on a structured methodology demanding multiple confirmations and overlaying it all with stringent risk management is incredibly clear from Rosewag's work. But to fully master these strategies and truly understand the market's behavior, you also need to consider the broader market context, right? Let's talk about the role of futures and outside resources.
Absolutely. You can't just trade a stock in a vacuum. Understanding the overall market sentiment and flow is crucial context. And Rosewag argues that futures are arguably the market's best real-time crystal ball for gauging this overall sentiment.
Futures contracts. How do they work briefly, and why are they like a crystal ball?
Futures are essentially contracts that obligate a buyer to purchase or a seller to sell an asset, like a commodity like oil or gold or a stock index, at a predetermined price on a specific date in the future. They're used by institutions for hedging, but also heavily by speculators to bet on future price direction. What's crucial for stock traders is that futures movements, particularly index futures, often precede actual stock price changes in the underlying cash market.
So if the S&P 500 futures start rising strongly in the pre-market, the actual stocks in the S&P 500 are likely to follow suit when the market opens.
Exactly. That's the general relationship. He highlights 3 key index futures to watch. S&P 500 futures, ES, gives an overall view of the entire stock market as it tracks the 500 largest U.S. stocks across various sectors. Big Money heavily trades ES, influencing the broad market. NASDAQ Q 100 futures, NQ, primarily tracks the 100 largest non-financial companies listed on the NASDAQ Q, so it's heavily weighted towards tech stocks. If NQ is rising, tech names like AOPL, MSFT, AMZN, and VAT typically follow. Dow Jones 30 futures, YM, tracks just 30 prominent large-cap U.S. companies across diverse sectors like healthcare, J&J, banking, VEDA's heirs, retail, HDs, and industrials, Billy A. Its movement reflects the sentiment in these more established sectors.
So you watch the futures contract that best relates to the stock or sector you're trading.
Precisely. The key principle is correlation. For the highest probability trades, you want the relevant futures contract and the individual stock you are trading to be moving in sync, providing double confirmation. He shows compelling charts where the intraday price action of $5 Meta almost perfectly mirrors NASDAQ Q futures and BLR Boeing mirrors DOW Jones futures. When they align, your trade has the wind of the overall market at its back.
Does he also watch commodity futures?
Yes, particularly as trading-related stocks. He notes crude oil futures, CL, are critical for trading oil stocks like XLM or TVX, showing their price action is often identical. Similarly, gold futures, GC, are vital context for gold-related stocks or ETFs like Gold Deal or GLD. His recap is clear. Always perform your technical analysis, support resistance, MAs, etc., directly on the futures charts themselves. They are an incredibly powerful tool for confirming the direction and strength of your potential stock trades.
That covers the market's real-time pulse via futures. Beyond the charts and futures, what other outside resources does Rosewag leverage to get a comprehensive picture and find opportunities? News, flow, sentiment.
Yes, he stresses that truly successful trading requires synthesizing information from multiple angles. The technical data on the charts, fundamental news catalysts, tracking institutional money flow, and even gauging social sentiment to find hot stocks. It's about building a complete mosaic.
Okay, where does he get his market news?
He mentions common sources like Yahoo Finance, but his personal favorite seems to be Benzinga Pro for its live news feed, which includes breaking headlines, analyst price target upgrades and downgrades, M&A news, and lists of pre-market and after-hours movers. He also mentions Zacks and keeping an eye on financial news outlets and specific accounts on Twitter like Zero Hedge, CBC Alerts, Bloomberg Markets for rapid information dissemination.
News is important context. What about tracking that smart money or institutional flow? He uses flow scanners.
Yes, this is a critical piece for him, trying to see where the big players might be placing their bets, particularly in the options market. His preferred flow scanning services are callsrbooks.com and flowaldo.com. He pays close attention to specific types of large orders flagged by these services. Sweep orders. These are large market orders that are broken up and executed simultaneously across multiple exchanges. The goal is to get a large order filled very quickly, often indicating urgency or strong conviction from smart money about an impending big move. Block trades. These are very large orders that are typically negotiated privately between institutions and executed off the public exchanges.
So seeing large sweeps or blocks come through might signal a big move is coming.
It might, but here Rosewag offers a very crucial warning. You must always combine observations from options flow scanners with your own technical analysis on the stocks chart. Never trade based on flow alone.
Why not? If it's smart money, shouldn't you follow it?
Because the flow data doesn't tell you the reason behind the trade. A very large call sweep, for example, might not be a simple bullish bet. It could actually be a hedge for a much larger short position in the underlying stock, or maybe hedging a complex portfolio. He gives a fascinating real-world example involving SAGS-PXU and inverse S&P 500 ETF. During a period of market fear surrounding the Kabul airport bombings, huge call sweeps came into SAGS-PXU. Someone just looking at the flow might think, wow, smart money is betting big on the market crashing.
But that wasn't the whole story.
No. Rosewag explains it was far more likely that large institutions holding massive long positions of the S&P 500 were buying those SAGS-PXU calls as a cheap hedge against a potential short-term drop due to the geopolitical uncertainty. Without understanding the broader context and confirming with technical analysis, which might not have shown a bearish breakdown, blindly following that SAGS-PXU call flow would have led you to make the wrong trade. Technical alignment is non-negotiable. Flow is just supporting evidence, potentially.
That's a really important distinction. Flow is a clue, not a conclusion. What about finding those hot stocks based on social sentiment?
He does pay attention to this, acknowledging its power in the modern market. He suggests joining active stock market Facebook groups to see what retail traders are buzzing about. He actually credits discovering NIO early on, when it was trading around $3 before its massive run to $67, partly due to the intense hype he saw surrounding it on Facebook. He also monitors Twitter, often called FinTwit, for fast-paced news and sentiment shifts. And he keeps an eye on broader sentiment indicators like the Fear and Greed Index, quoting Warren Buffett's famous advice, "Be fearful when others are greedy, and be greedy when others are fearful."
So gauge the crowd sentiment, but don't necessarily follow it blindly. Finally, what about the economic calendar? Key reports.
Yes. Being aware of major scheduled economic releases is crucial, as they can cause significant market volatility. Key reports he flags include Consumer Price Index, CPI, measures inflation at the consumer level. High CPI readings often spook the market. Producer Price Index, PPI, measures inflation at the producer level, also hinting at broader inflationary pressures. Jobless claims and unemployment rate, indicators of economic health. Lower numbers are generally seen as bullish for stocks. And perhaps most importantly, Federal Reserve announcements and speeches by the Fed chair, like Jerome Powell. Rosewag explicitly advises not actively trading during these Fed events. A single sentence about interest rates or tapering can cause massive, unpredictable swings in the entire market within seconds. He shows a chart of Slung IRI rallying dramatically immediately after Powell gave no tapering news, illustrating the immense impact these events can have. Better to be flat and watch from the sidelines during peak uncertainty.
That's a huge amount of information to synthesize daily technicals, futures, news, flow, sentiment, economics. It truly sounds like successful trading is about piecing together a complex, ever-changing puzzle. But arguably, all this technical skill and fundamental analysis is rendered useless if you don't have the right mindset. Let's talk about the critical topics of risk management and emotional trading. Rosewag dedicates significant attention to this, doesn't he?
He absolutely does, calling risk management the most important concept in all of trading. He drives this home with a stark, cautionary tale of a trader he knew who impressively turned an initial $5,000 account into $27,000 trading TSLA options.
Wow, that's amazing.
It was.
Hmm.
But then, fueled by overconfidence and a complete lack of risk management, that same trader put the entire $27,000 into just one or two subsequent trades and lost all of it in just 3 days.
Oh my God.
Yeah.
From 27K to zero in 3 days.
Yeah. Exactly. It illustrates perfectly why, as Rosewag says, it only takes one poorly managed trade to wipe out weeks or months of hard work or even your entire account if you don't have strict risk controls in place. It's non-negotiable.
Okay, so what are his core risk management rules then? The absolute non-negotiables that traders must follow to survive.
He lays out 4 simple but absolutely critical rules. Rule #1. Never use more than 10–15% of your total trading account capital in active trades at any one time. For newer traders, he suggests an even more conservative 5–10%. This means the vast majority of your capital should be sitting safely in cash, protected from market swings. You absolutely avoid putting 100% of your capital on the line. Rule #2. Never have more than 2–3 open positions, active trades, at the same time. Avoid spreading yourself too thin mentally and financially. Focus your capital and attention only on the highest probability setups you identify. Quality over quantity. Rule #3. Stick to your stop loss. Always. Before you even enter a trade, you must calculate your maximum acceptable loss on that specific trade and set a stop loss order accordingly. If the trade moves against you and hits that stop loss, you exit the trade immediately. No questions asked. Admit you were wrong on that trade and move on. Never widen your stop loss hoping the trade will come back. That's how small losses turn into catastrophic ones. Rule #4. Stop listening too much to others' opinions. Avoid bandwagon bias or blindly following alerts or tips from gurus or social media. Do your own thorough research using the methods discussed. Form your own conclusions based on confluence and trade your plan.
Those rules are straightforward, but sound incredibly difficult to follow consistently, especially that stop-loss rule when a trade goes against you.
They are difficult psychologically. Rosewag acknowledges that trading is inherently uncertain, maybe a 50-50 game on any single outcome. But rigorously applying these risk management rules is what skews the odds of long-term survival and success in your favor. Technical analysis gives you an edge in identifying potential opportunities, the upper hand, but risk management is what keeps you in the game long enough for that edge to play out over many trades.
Risk management protects your capital. Now, the other side of the mental coin, emotional trading. He's quite open that this struggle almost made him quit trading entirely early on.
Yes, and it's a battle almost every trader faces. Emotional trading, making impulsive decisions based on fear, greed, anger, or frustration rather than logic in your plan, is a huge hurdle. He identifies 3 main underlying causes. Cause 1, trading with money you cannot afford to lose. This is probably the biggest trigger. If you're trading with capital that you desperately need for rent, bills, or living expenses, every small loss will feel devastating and trigger intense fear or anxiety, leading to poor decisions like closing winners too early or letting losers run too long. His solution: only ever trade with risk capital, capital that you are okay with losing, mentally and financially. Cause 2, comparing yourself to others. This is a huge trap, especially with social media showcasing highlight reels. Never compare your trading journey, your P&L, or your learning curve to someone else's. Everyone's path is different. Trying to outperform a friend or match some guru's supposed gains leads to frustration, forcing trades, and emotional decision-making. Focus on your own process and progress. Cause 3, personal life stress. Trading requires immense focus and emotional stability. If you're going through a highly stressful period in your personal life, moving house, relationship problems, grief, illness, it's often best to take time off from active trading. Your judgment will likely be impaired. As he wisely notes, the market will always be there when you're in a better headspace.
That's really sound advice, and it's not just about anger or frustration, right? Fear plays a huge role, too.
Absolutely. Emotional trading isn't just about blowing up in anger after a loss. It's very often driven by the deep-seated fear of being wrong, the fear of taking a loss. But as Rosewag stresses, being wrong is a part of trading. Losses are absolutely unavoidable no matter how good your strategy is. The key isn't to avoid losses entirely, which is impossible, but to ensure that when they happen, they are small and controlled, thanks to proper risk management. Accepting losses as a cost of doing business is crucial for psychological survival. For anyone struggling deeply with this, he highly recommends reading Mark Douglas's classic book, Trading in the Zone, which focuses specifically on trading psychology.
Excellent recommendation. Okay, so master the technicals, master the risk, master the emotions. Finally, how do you take those hard-won short-term gains to generate long-term wealth? It's not just about making quick profits day to day. It's about building a sustainable financial future, right?
Precisely. This is the ultimate goal for most traders. First, and fundamentally, Rosewag emphasizes the importance of regularly paying yourself from your trading profits. Don't just let profits accumulate endlessly in your trading account, tempting you to take bigger and bigger risks. Decide on an appropriate amount of capital to keep in your trading account, an amount you're truly comfortable risking based on your risk management rules, and withdraw any excess profits on a regular basis, perhaps weekly or biweekly. This reinforces the idea that trading is a business generating income, and it helps prevent emotional attachment to ever larger account balances.
So take money out regularly. Then where should that money go to build long-term wealth?
He outlines several traditional avenues for using those withdrawn trading profits to generate long-term, potentially more passive, wealth. Building a long-term investment portfolio, this could consist of individual stocks, which he notes offer the most growth potential but require more research, exchange-traded funds, ETFs, or mutual funds. Building a long-term investment portfolio. For individual stocks, he shows examples like AAPL and NVDA significantly outperforming the broader market, SPY, since the 2020 sell-off, highlighting the potential of stock picking. Building a long-term investment portfolio. For ETFs, he mentions they are great for diversification, especially for those without time for individual stock research. He notes this SPY averages around 10% annually historically, and points to providers like Vanguard, VTI, ERKK funds, Invesco, and iShares, advising you to research different ETF strategies and returns. He also specifically highlights dividend investing, buying shares in stable companies that pay out regular thank you payments, dividends, to shareholders, often monthly or quarterly. He gives an example.
If TTNT pays $2.01 per share annually, owning 3,000 shares would yield $6,120 per year in passive income, likely beating standard bank account interest significantly. He also specifically highlights dividend investing, buying shares in stable companies that pay out regular thank you payments, dividends, to shareholders, often monthly or quarterly. He gives an example. He also briefly mentions other passive income sources like potentially investing in cryptocurrency or real estate as other avenues to explore for diversifying and building long-term wealth outside the stock market.
So the core message is clear. Use disciplined short-term trading, managed with strict risk control, as an engine to generate capital. Then consistently withdraw profits and deploy that capital into longer-term, potentially less volatile investments to build sustainable wealth and work towards financial freedom.
That's the blueprint he lays out. It connects the active trading component to the ultimate goal of long-term financial security.
Well, we have truly covered an incredible amount of ground in this deep dive. It feels like we've taken a comprehensive journey through Brandon Rosewag's new age of technical analysis. We started with the intricate mechanics of options trading and the vital insights provided by the Greeks. Then we moved into the visual language of the market, reading candlesticks and mastering key chart patterns that reveal market psychology.
Yeah, the patterns are key.
We explored the strategic guidance offered by dynamic moving averages, both EMAs and SMAs, and the crucial momentum indicators like Stochastics and the TTM Squeeze, which help uncover hidden market energy and potential turning points. We even journeyed through the broader market context, understanding the predictive power of futures and the essential outside resources like news and flow analysis that round out a trader's perspective.
Putting it all together.
And perhaps most importantly, we've touched on the critical mindset of a successful trader, delving into those non-negotiables of risk management and the ongoing battle with emotional control. All of this is designed to help you, our listeners, spot opportunities and navigate these complex markets with greater confidence and knowledge. This wasn't just spitting out information, it really felt like unpacking a comprehensive roadmap to approaching the markets like a seasoned expert.
And just to reiterate that core message that comes through so clearly from Brandon Rosewag's work, the absolute key to success, as he presents it, is consistently achieving confluence. That means patiently waiting for setups where all, or at least most, of your chosen indicators and analytical tools align across multiple time frames, all essentially telling you the same bullish or bearish story.
Right, not trading off one signal.
Exactly. It's this holistic, multifaceted approach demanding confirmation from various independent sources, combined with those absolutely crucial pillars of disciplined risk management and unwavering emotional control that truly sets you up for potential long-term success in this challenging field. The market is undoubtedly a complex, constantly evolving puzzle, but with the right tools, the right preparation, the right patience, and the right mindset, you can indeed begin to piece it together much more effectively.
As we wrap up this deep dive, you might be sitting there wondering, okay, what hidden patterns, what confluence signals are waiting for me to discover in the market right now? Hopefully, the material we've covered today provides a powerful framework for your own journey of discovery and analysis. For those of you eager to explore Brandon Rosewag's work further, you can find him on Instagram and Twitter. His handle is @Carhorns, CARWHORNS. And his YouTube channel, packed with hundreds of videos demonstrating these concepts, is simply Brandon Trades. His overall message seems to be one of encouragement. Stay motivated, chase your dreams, and always remember why you started on this path.
And he leaves readers, and us, with a really provocative final thought, actually quoting one of his favorite rappers, Logic. How can the greatest fear be a life unlived? It's a powerful question. And that challenge really extends far beyond the charts and trading screens. It serves as a potent reminder that perseverance, developing belief in yourself, and actively cultivating a winning, resilient mindset are truly transformational forces, not just in the demanding world of trading, but in navigating life itself.